Indexed Universal Life Insurance versus ETF Retirement Plans. Building your wealth legacy. Imagine standing at the crossroads of your financial future. You've diligently built substantial wealth. Perhaps you're approaching or even enjoying retirement. And now the critical question emerges. How do I ensure this wealth continues to grow, provides reliable income, and leaves a lasting legacy for my loved ones, all while minimizing taxes? Many of you, our discerning listeners, are evaluating powerful tools for wealth accumulation and distribution. Two frequently discussed options are indexed universal life insurance policies and exchange-traded fund, ETF, retirement plans. But which path is truly right for your unique financial landscape? Today, we're going to demystify these complex instruments, providing clarity and confidence for your most important financial decisions. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this valuable information. Now let's continue. Welcome, savvy investors and forward-thinking retirees, to a crucial conversation that impacts your financial security for decades to come. I'm here to be your trusted guide as we explore two distinct, yet powerful, approaches to retirement planning and wealth preservation. The Indexed Universal Life Insurance Policy, often referred to as an IUL, and ETF-centric retirement plans, typically held within brokerage or tax-advantaged accounts like IRAs or 401ks. Think of your financial journey as charting a course across vast waters. An ETF retirement plan might be like a well-charted ocean liner, transparent, generally low-cost, and directly exposed to the market's open seas, offering the potential for significant speed and growth. An indexed universal life policy, on the other hand, could be likened to a specialized armored vessel. It offers market-linked growth with built-in protections against severe storms, a unique death benefit, and distinct tax advantages. Both can get you to your destination, but they do so in fundamentally different ways, with different costs, risks, and benefits. Our goal today is to help you understand these differences, empowering you to choose the vessel that best fits your financial goals and risk tolerance. Section 1. Understanding Indexed Universal Life, IUL policies. Let's begin our deep dive with Indexed Universal Life, or IUL, a type of permanent life insurance. This isn't just about a death benefit paid to your beneficiaries. It's a sophisticated financial product designed for both life insurance coverage and cash value accumulation. Now, what is an IUL? At its core, an IUL policy has two main components. First, a death benefit. This is a guaranteed, generally tax-free lump sum paid to your designated beneficiaries upon your passing. It provides crucial financial protection for your loved ones, or can be a powerful estate planning tool. Second, a cash value account. This is where the magic of potential wealth accumulation happens. A portion of your premium payments goes into this cash value, which grows over time. What makes an IUL unique is that its cash value growth is linked to the performance of a specific market index, such as the S&P 500, but without directly investing in the stock market. Now, how does IUL's cash value grow? The insurance company doesn't put your money into the index. Instead, they credit interest to your cash value based on the index's performance. Here's the critical part for our high net worth individuals. Participation rate. This determines what percentage of the index's gains you participate in. If the index goes up 10% and your participation rate is 80%, you get 8%. Cap rate. This is a ceiling on how much interest your cash value can earn in a given year, regardless of how high the index performs. So, if the index soars by 18%, but your cap is 10%, you still only get 10%. Floor rate. This is the game changer for downside protection. It's a guaranteed minimum interest rate, often 0% or 1%, meaning if the index drops significantly, your cash value won't lose money due to market downturns. It simply earns the floor rate, safeguarding your principal. Now, key benefits of IULs for retirement planning and wealth preservation. Tax-advantaged growth. The cash value in an IUL grows tax-deferred, meaning you don't pay annual taxes on the gains. And, crucially for retirement income, you can typically access your cash value through policy loans and withdrawals that are generally income tax-free, provided the policy remains in force. This can offer a powerful stream of supplemental retirement income without triggering a taxable event. Downside protection. As we discussed, the floor rate offers a shield against market crashes, providing a level of security that direct market investments cannot. This is huge for risk management in later life. Flexibility. IULs often offer flexible premium payments, allowing you to adjust contributions based on your financial situation. Death benefit. It provides essential legacy planning and estate liquidity, ensuring your family is financially secure or helping to cover estate taxes. No required minimum distributions. RMDs, unlike traditional retirement accounts like 401k, and IRAs, IULs don't have RMDs at a certain age, giving you more control over your income distribution. Potential downsides and important considerations. Fees and costs. IULs come with various fees, including cost of insurance, administrative fees, and surrender charges if you cancel the policy early. These can significantly impact returns, especially in the initial years. Cap rate limitations. While the floor protects from losses, the cap limits your upside, meaning you might miss out on full market gains during strong bull runs. Complexity. IULs are not simple products. Understanding the mechanics of participation rates, caps, and fees requires careful study, often with a financial advisor specializing in insurance planning. Section 2. Understanding ETF retirement plans. Now, let's shift our focus to ETF retirement plans. When we talk about this, we're generally referring to investing in exchange-traded funds within common retirement vehicles like a traditional IRA, a Roth IRA, or an employer-sponsored 401k. These are your direct access points to the market. What are ETFs? An exchange-traded fund is a basket of securities, like stocks, bonds, or commodities, that trades on a stock exchange, much like individual stocks. Think of it as a diversified portfolio wrapped up in a single, easily tradable share. Now, how ETFs work in retirement plans. When you invest in an ETF retirement plan, you're selecting specific ETFs to hold within a brokerage account that is designated as a retirement account. IRAs, individual retirement arrangements, both traditional and Roth IRAs, allow you to choose from a wide range of ETFs. Traditional IRA. Contributions might be tax-deductible, growth is tax-deferred, and withdrawals in retirement are taxed as ordinary income. Roth IRA. Contributions are made with after-tax dollars, but qualified withdrawals in retirement are completely tax-free, including all growth. This is a powerful tax-free income stream for retirement. 401(k)s, employer-sponsored retirement plans, while some 401(k)s offer ETFs directly. Many provide access through mutual funds or a brokerage window that allows ETF purchases. Contributions are often pre-tax, and growth is tax-deferred. Key benefits of ETFs for retirement planning and wealth management. Diversification. ETFs inherently offer portfolio diversification. One ETF can give you exposure to hundreds or thousands of different companies or assets, spreading out your risk across various sectors, industries, or even global markets. This is crucial for risk management in your investment portfolio. Low costs. Most ETFs are passively managed and track a market index, leading to very low expense ratios compared to actively managed mutual funds. Lower fees mean more of your money stays invested and continues to compound. Transparency. ETFs generally disclose their holdings daily, so you always know exactly what you own. Liquidity and flexibility. ETFs trade like stocks throughout the day, offering greater trading flexibility if you need to adjust your asset allocation. Market participation. ETFs directly participate in market gains, with no caps on upside potential. If the market goes up 18%, your ETF, tracking that market, aims to reflect that full gain. Potential downsides and important considerations. Market risk. ETFs are directly exposed to market volatility. There's no downside protection or floor like an IUL. If the market drops, your portfolio value will decline. No death benefit, beyond account value, while your beneficiaries inherit the account balance. There's no separate, guaranteed, and potentially increasing death benefit component beyond the investment value itself, unlike life insurance. Taxable events. In non-qualified accounts, while ETFs held in IRAs or 401(k)s benefit from tax deferral, ETFs held in regular, taxable brokerage accounts can trigger capital gains taxes when sold for a profit, or taxes on dividends received. Sequence of returns risk. This is a major concern for early retirees. If you start withdrawing from your ETF portfolio during a significant market downturn early in retirement, it can severely deplete your capital and shorten your financial longevity. IUL's floor rate can mitigate this specific risk. Self-management responsibility. While easily accessible, building a diversified ETF portfolio requires a degree of knowledge or the guidance of a fiduciary financial advisor. Section 3. Indexed Universal Life versus ETFs. A strategic comparison for your retirement journey. Now that we understand each product, let's place them side by side to highlight their strategic differences for retirement income planning and wealth preservation, especially for our high net worth clients in the US and Canada. This isn't about one being inherently better. It's about which tool fits which specific need in your holistic financial plan. 1. Growth potential versus downside protection. ETFs offer uncapped market participation. When the market soars, your ETF portfolio can capture those full gains. This is fantastic for aggressive growth when you have a long investment horizon. However, they also bear full market risk. IULs provide market-linked growth with a cap on the upside, but crucially offer a floor rate, often 0%. This means you sacrifice some of the highest potential gains, but gain significant downside protection. This stability is very appealing for those prioritizing principal protection over maximum market upside, especially as they get closer to or enter retirement. 2. Tax efficiency and access to funds. ETFs in qualified accounts, IRAs/401ks enjoy tax-deferred growth, traditional, or tax-free withdrawals, Roth. These are powerful vehicles. However, traditional IRAs/401ks are subject to required minimum distributions, RMDs, in retirement, meaning you must start taking taxable withdrawals at a certain age, whether you need the money or not. IULs, which is short for Indexed Universal Life, offer tax-deferred cash value growth and, crucially, tax-free access to funds through policy loans and withdrawals. There are no RMDs with an IUL. This flexibility makes IUL a powerful tool for tax diversification in retirement, providing an alternative source of tax-free income alongside your Roth accounts. Imagine having control over when you access your income, without being forced to take distributions that could push you into a higher tax bracket. 3. Insurance component versus pure investment. ETFs are purely investment vehicles. Your beneficiaries receive the account's market value upon your passing. There's no separate, escalating death benefit feature. IULs include a substantial death benefit alongside the cash value. This acts as family protection, can provide liquidity for estate taxes, or be a strategic component of your legacy planning. This dual benefit is a key differentiator for affluent individuals concerned with multi-generational wealth transfer. For fees and costs, ETFs generally have very low expense ratios, making them incredibly cost-efficient for long-term investing. Brokerage commissions for buying/selling ETFs are often zero. IULs have higher internal costs and fees due to the insurance component, administrative expenses, and the cost of the guarantees, floor rate. It's essential to understand these fees and how they impact your net returns. 4. Fees and costs. ETFs generally have very low expense ratios, making them incredibly cost-efficient for long-term investing. Brokerage commissions for buying/selling ETFs are often zero. IULs have higher internal costs and fees due to the insurance component, administrative expenses, and the cost of the guarantees, floor rate. It's essential to understand these fees and how they impact your net returns. 5. Liquidity and control. ETFs, highly liquid and transparent. You can buy and sell throughout the trading day. IULs, while you can access cash value via loans/withdrawals, there can be surrender charges if you cancel the policy in the early years. They are less liquid than ETFs. When might each be most suitable? ETFs in retirement plans are often ideal as the core foundation of your retirement savings for aggressive growth, cost efficiency, and broad market participation, especially for those with a long time horizon and a higher tolerance for market volatility. They excel at maximizing investment returns. Indexed universal life policies can be a powerful supplementary tool, particularly for high net worth individuals seeking tax-free income distribution in retirement without RMDs, downside protection for a portion of their cash accumulation, a significant, generally tax-free death benefit for estate planning and legacy wealth transfer, integration of long-term care riders or chronic illness riders for potential living benefits. This isn't an either/or choice for many successful individuals. Often, A well-structured financial plan incorporates both leveraging the growth potential and cost efficiency of ETFs in traditional and Roth accounts, while strategically utilizing an IUL for tax diversification, principal protection, and estate planning benefits. Section 4. Navigating your path. Step-by-step guidance and building trust. Understanding these powerful tools is the first step. The next is to apply this knowledge to your unique situation. This is where professional, trusted guidance becomes invaluable. Step-by-step guidance for your retirement and insurance decisions. Assess your financial goals and risk tolerance. Action. Take an honest look at your current net worth, desired retirement lifestyle, income needs, and how comfortable you are with market fluctuations. Are you primarily focused on aggressive growth, or is wealth preservation and tax-free income paramount? Why? This foundational step determines which tools align with your personal philosophy. Conduct a comprehensive financial review. Action. Gather all your financial documents, investment statements, existing insurance policies, income statements, and a detailed budget of your retirement expenses. Why? A complete picture of your financial health is essential for any strategic planning. Model tax implications. Action. Work with a tax professional or a financial advisor who understands complex tax planning strategies. Model scenarios for withdrawing from traditional IRAs, Roth IRAs, and potentially IULs in retirement. Understand tax-efficient withdrawal strategies. Why? Tax optimization can save you hundreds of thousands of dollars over your retirement lifetime, significantly impacting your disposable income. Evaluate your need for life insurance and estate planning. Action. Consider your legacy goals. Do you need to provide for a surviving spouse, children, or grandchildren? Are there potential estate tax liabilities that a death benefit could cover? Why? If a tax-free death benefit and estate liquidity are high priorities, an IUL's unique features become much more compelling. Seek fiduciary financial advice. Action. Consult with a fiduciary financial advisor who specializes in retirement planning, wealth management, and has expertise in both insurance products and investment strategies, including ETFs. A fiduciary is legally bound to act in your best interest. Why? This complex comparison requires personalized guidance. A qualified advisor can analyze your specific situation, run sophisticated projections, and help you determine if an IUL fits alongside your ETF portfolio, or if one is clearly a better fit for your primary objectives. They can illustrate the impact of IUL fees and caps versus ETF market returns over your projected longevity. Building trust in these crucial decisions comes from clear understanding and objective advice. Our aim is to provide that clarity, empowering you to ask the right questions and make the most informed choices for your financial well-being. Conclusion and call to action. Whether your primary focus is on maximizing investment returns with the transparency and low costs of ETFs in your retirement accounts, or you seek the unique combination of tax-advantaged cash accumulation, downside protection, and a significant death benefit offered by an indexed universal life policy, remember this: both are powerful tools. The key is understanding their distinct roles within your comprehensive financial strategy. The choice isn't always one or the other. For many discerning individuals, a strategic combination of both can create a highly resilient and tax-efficient retirement income plan, safeguarding your wealth and building a lasting legacy. If this in-depth discussion has brought you clarity and sparked valuable insights into your retirement planning options, please take a moment to like this video. Your engagement helps us reach more individuals seeking this vital financial guidance. We encourage you to share your questions and experiences in the comments below. We love hearing from you and building this knowledgeable community. And for more expert advice and strategies to navigate your financial future, be sure to subscribe to our channel and turn on notifications so you don't miss our upcoming content. Your financial success